On the program today, France to provide Sudan with $1.5 billion bridge loan to clear arrears. Algeria is to reopen air and land borders on June 1. And power generation wars in Ivory Coast and Ghana hit industry and neighbors. Hello and welcome to Business Incorporated. Thank you for joining us. I'm Chimeze Obi Iwag. We'll begin the show with intraday market numbers, starting off here on the African continent where trading were mostly negative. Only the South Africa's JSE index was in the green amongst the markets we track on the show, up 0.24%. Nigeria's main index fell 0.13% at intraday. Elsewhere, the EGX 30 in Egypt dipped 0.85%, while the market in Kenya ended negative on Thursday. In the Gulf region, investor sentiments were mostly positive across markets we follow. At intraday, the Abu Dhabi index advanced by 0.77%, while Dubai's index gained 0.32%. Saudi Arabia's index rose 0.63%, while the Qatari's market depreciated by 1.21% at intraday. And European stocks were choppy in the morning as global investors weighed concerns over a rise in inflation and an increase in coronavirus cases, largely attributed to the spread of a variant that emerged in India. For more, let's talk to Conrad. Hello, Conrad. Good afternoon. Good to see you. I understand it's quite cold there. It's quite hot here. Not too sure if I'm enjoying the hot weather as it's quite humid.
Well, to me, yes. For being mid-May, it's really cold and it's very rainy. Cold, meaning a little bit higher than 10 degrees. But too cold for a month of May, that's at least according to everyone here in this city. We all want a warmer weather.
Well, just take good care of yourself and cover yourself up for the cold. Anyway, Europe's largest discount airline, Ryanair, has reported a loss of 850 million euros for the last year. How's the market reacting? Are these numbers bad or really bad?
Well, Jimmy, this amount of an 815 million euro loss for Ryanair in the last year is at the better end, actually, of what analysts had been predicting. So I think it's fair to say these are, of course, bad numbers, but it could be worse. As a consequence, the share price of Ryanair today managed to rise slightly above last Friday's closing price. What's also worth mentioning, I think, is that Ryanair is among the very few airlines in Europe which managed to get through the corona pandemic without taxpayers' money. All other competitors of Ryanair, Lufthansa, Air France, KLM, also SAS, the large Scandinavian airline, they all needed money from the governments in order to be able to deal with the recession that happened for them due to the corona pandemic. And because of this, I think that it's also fair to say that Ryanair has a bit of an advantage to its competitors when it comes to, appealing to investors.
And Ryanair hopes for a recovery this summer. How realistic are these hopes?
Well, I think that the very hopeful outlook that Ryanair gave out today might be a bit too optimistic. Yes, there's likely going to be more traveling to and from the United Kingdom as so many Brits have been vaccinated by now and as the so-called green list of safe countries keeps growing. On the other hand, nobody really knows what kind of consequences the new variant of the virus will have, the so-called Indian variant, which has reached the United Kingdom already. And of course, the UK is only one market for Ryanair. Here in Germany, for example, the government still has in place many travel warnings about some of Germany's favorite travel destinations, like Spain, Italy, Croatia. And as a consequence, it's expected that the number one travel destination for Germans this year will be Germany itself. They will do domestic traveling. And for that, the country is small enough. You don't need a Ryanair flight ticket. You just travel by train, by bus, or by car.
Well, Conrad, I guess we'll have to discontinue with this. You have having some kind of issues with your audio there. I will probably have to get it fixed. Okay, coronavirus restrictions have been eased further in England, Wales, and most of Scotland. However, report shows UK faces labour shortage as COVID and Brexit fuel exodus of overseas workers. Let's hear more from Juliana. Hello, Juliana. Good afternoon. Well, coronavirus restriction is being eased. However, report indicates employers are struggling to hire staff. If this report is anything to go by, what are the risks for the job market?
Well, I suppose we'll have to wait and see, Chimaze. We get some unemployment data tomorrow. Unemployment currently stands at about 4.9% here in the UK. Look, I think, is it a significant deal? Perhaps if you're one of those chains, but I don't necessarily think that's the biggest story of the day here. I think restaurateurs, the hospitality sector are breathing a sigh of relief that finally, after 3 lockdowns, that they can open their doors indoors. I heard you speaking to Frankfurt there about the weather. I can tell you it's also exceptionally cold here in the UK, as it always is, and people had been shivering outside. But, I suppose the seriousness of this story really is the government having to look at the hospitality sector, because like the airlines, staff have suffered. A lot of staff that do work in hospitality, whether you're a chef, a bartender or a waitress, you typically work very, very long hours, low pay, having to rely on tips, and the fact that you've been in and out of the job over the past year and a half just hasn't been good enough. And yes, there are some restaurants that have suffered with some staff shortages, particularly hotels that are outside London or are in the east or the south of England that do rely on a lot of foreign staff, Brexit as well, and the ifs, coulds, woulds, nots that are surrounding that question have made a lot of people decide to leave the sector, and unfortunately for some, leave the country. But yeah, it's still a very good day, the fact that you can eat inside once again.
All right, let's look at the corporate world. The last remaining Debenhams are closing their doors on Saturday, more than 240 years after the department store began trading. Shoppers have flocked to the last remaining outlets to pick up bargains in closing down sales. Are you also taking advantage of this?
I wish I did, actually, but I'm too late, because it's actually last Saturday just gone, the last remaining Debenhams stores closed, as you said, after 240 years. I think the story of Debenhams is a similar story that we've discussed over the past year or so, isn't it, Chimmy? The fact that a high street store, particularly those old-fashioned department stores, a lot of young, new shoppers, they're not used to that style of shopping. They're used to buying things quick, online and cheap, and Debenhams just couldn't keep up with that. And then, of course, came the pandemic, and that was basically the straw that broke the camel's back for some people who do like the brand, resonate with the brand. As you said, it's been going for 240 years. They will have an opportunity to still purchase from Debenhams, because the Boohoo Group did buy, I believe, the intellectual property as well as some of Debenhams' own brands for about £55 million a couple of months ago. So that stuff will still be trading online. But yes, sadly, another one bites the dust.
All right, as a new week starts and restrictions are eased, how are the markets trading this intraday?
Yeah, well, in the square mile, down is the term taken from lockdown, down. I think all of the sentiment is really coming from Asia. We had some mixed economic data from China showing that retail sales had slumped. Of course, everybody looks at China for a segue into how the economic recovery is panning out. A little bit of shivers from that. Of course, inflation is still always going to be in the background. We get our own set of inflation figures on Wednesday. We're expecting to show a jump from 0.7% to 1.4%. A lot of investors are getting anxious about that. So the FTSE All-Share is down at intraday by 0.56%. The FTSE 100 is down by 0.64%. And the FTSE 250 also down by 0.19%. In currencies, the British pound is up on the US dollar by 0.08%, down on the euro by 0.08%, and also down on the Japanese yen by 0.18%, Jimmy.
Well, I guess the week is heavy on data, so we'll keep a track on those. We'll talk tomorrow. Enjoy the rest of the day.
Thank you. Thank
And shares in Asia Pacific were mixed today as investors reacted to the release of Chinese economic data while also monitoring the COVID situation in places such as Taiwan, which has seen a recent spike in domestic infections. The TAIEX in Taiwan fell 2.99%, leading losses among the region's major markets. Elsewhere, mainland Chinese stocks were higher on the day, with the Shanghai Composite up 0.78%, while the Shenzhen component surged to 1.74%. The Hang Seng Index in Hong Kong rose about 0.7% as of its final hour of trading. The moves came following the release of a slew of Chinese economic data. In Japan, the Nikkei 225 dipped 0.92%, while the Topix index shed 0.24%. South Korea's Kospi closed 0.6%. In Australia, the S&P ASX 200 gained 0.13% to close at 7,023.6. And stock futures in the U.S. were slightly lower earlier today, following last week's sell-off triggered by inflation jitters. Futures on the Dow Jones Industrial Average pointed to an opening loss of about 71 points. Both S&P 500 futures and Nasdaq 100 futures traded marginally lower. Wall Street came off one of the wildest weeks of 2021 that saw the S&P 500 fall 4% through midweek and heightened inflation fears. The broad equity benchmark eventually ended the week down 1.4% after a back-to-back rally. On the global oil market, prices were mixed on a tight range in early trade after the recovery of a major U.S. pipeline network eased concerns over supply, though fresh restrictions in Asia amid surging COVID-19 cases weighed on sentiment. Brent crude oil futures were up 3 cents at $68.74 a barrel, and West Texas Intermediate crude was up 8 cents at $65.45. The two contracts jumped nearly 2.5% on Friday and managed to book a small gain last week, marking a third consecutive weekly increase. Investors remain cautious and worries that a highly transmissible coronavirus variant first detected in India is spreading to other countries. And on metals, gold prices rose to a 3-month high in early trade as a weaker dollar and a dip in treasury yields boosted metals' appeal after data last week showed U.S. retail sales unexpectedly soared in April. Spot gold was up 0.1% at $1,844 per ounce after hitting its highest since February 10 in early Asian trade. U.S. gold futures rose 0.4% to $1,845. In other metals, palladium gained 0.2% to $2,898 per ounce. Silver eased 0.1% to $27.38, and platinum fell 0.2% to $1,222. After the break, Sudan hopes to secure debt relief in a conference in Paris today. This and more from the African continent in a moment. A Kenyan High Court on Thursday ruled that the constitutional review process initiated by President Uhuru Kenyatta is illegal and has been a source of great tension in Kenyan politics in recent months. The reform, known as the Building Bridges Initiative, aims to dilute the current winner-takes-all rule, which Kenyatta sees as the cause of repeated post-election conflicts in his country. Matt Keniga, Associate Practice Lead, Sub-Saharan Africa at Frontier View in London, joins us now to look at what this would mean for political and economic stability in Kenya. Good afternoon, Matt. Good to see you.
Good afternoon. Thanks for having me on the show today.
So why is the Building Bridges Initiative so significant, and what does it aim to achieve?
Yeah, so the Building Bridges Initiative is the first major or the most significant constitutional change that would occur to Kenya since the country became independent in 1963. And the whole idea is that it would change the the structure of the way that the post-Kenyatta government would function. The aim of the Building Bridges initiative is to reduce the risk of political instability, political violence, by making the functioning of government more inclusive. And as you've said in the introduction, move away from the winner-takes-all approach that Kenyan politics currently has. The primary way it would do this is to make the executive arm of government more powerful through the creation of the post of prime minister. It also wants to increase the number of constituencies that are represented in parliament. But critics have said that it's a very sort of thinly veiled way of consolidating power amongst the established political elites in Kenya, and it actually makes it more difficult for new parties to challenge the way that government is being run, or for new parties to win elections in the future. So very controversial.
So what does this recent court ruling mean for the risk of political instability during the 2022 elections?
So I think this is the big question on everyone's mind. You know, people who are watching Kenya, businesses that are operating in Kenya, will we see a repeat of the 2007, 2008 political violence? So Kenya certainly does have a history of difficult elections and some violence around elections. We can't rule out a repeat of this, and we can't rule out an increase in political instability over the coming years. There has been an increase in political uncertainty in Kenya since President Kenyatta and his former ally, William Ruto, fell out in 2018. And just a couple of months ago, we've seen the establishment of a new political alliance called the One Kenya Alliance, which is seeking to win the election next year. So in summary, there's a lot more instability. And also, if the Building Bridges initiative dies completely, so if this court ruling results in the BBI initiative collapsing, then we could see William Ruto, who's one of Mr. Kenyatta's rivals now, getting a bit more political credibility from this. So it could increase his chances of winning the election. So in summary, I don't think there is a risk of political violence and unrest next year, but probably not as high as it was in 2007.
Okay, so do you expect political uncertainty to affect Kenya's economic outlook over the coming year?
It certainly can't be ruled out. So we would expect some weakening of business sentiment ahead of the elections, especially, towards the end of Q1, beginning of Q2 in 2022. We could see a slowdown in foreign direct investment. Tourism is already very weak, so we don't think it will. We don't think the tourism sector will be particularly badly affected. There is increased risk of shilling volatility, which could affect businesses. But overall, I would say that the outlook for Kenya's economy is broadly very positive, even if there is a period of unrest and violence around the elections. This period probably would be quite short-lived. And fundamentally, the Kenyan economy is the outlook for the Kenyan economy is quite bright. It has a broad range of drivers, very strong exports, quite an attractive investment environment, and public finances, although they're not great, they are probably going to improve over the next couple of years. So overall, the outlook for the Kenyan economy is pretty good despite political uncertainty.
All right, thank you very much, Mart. We always appreciate your time. Enjoy the rest of the day.
Thank you very much, you too.
And France has promised to lend Sudan $1.5 billion to help the African nation pay off its massive debts to the International Monetary Fund as it emerges from decades of authoritarian. Finance Minister Bruno Le Maire made this known at the opening of an international conference aimed at helping Sudan in its transition to democratic government. Sudan's Prime Minister Abdallah Hamdok is attending the Paris conference, seeking help in paying off a $60 billion foreign debt bill and also hoping to secure investment deals. Hamdok is pushing to rebuild and reform a crippled economy and end Sudan's international isolation under former dictator Omar al-Bashir, whose 3 decades of rule were marked by economic hardship and international sanctions. And Algeria plans to reopen its air and land borders on June 1, but strict measures will be imposed to limit the spread of the coronavirus. According to the plan, only 5 flights a day from and to Algerian airports will be allowed with full adherence to strict precautions. The government plans to announce more details on this week. Algeria closed borders and suspended all flights in March 2020 when the number of COVID-19 infections started to increase, but domestic flights resumed in December last year. And a drop in electricity generation in Ivory Coast and Ghana has left households and businesses fuming, as well as cutting power supplies to neighboring West African countries, Mali and Burkina Faso. A prolonged dry season has reduced water levels at hydropower dams in both countries that in some cases could take months to resolve, hampering productivity, raising costs, and hitting the economies of the world's biggest cocoa producers. Let's watch this.
In Ivory Coast, which exports power to 6 countries, the national power company faces a generation deficit of about 200 megawatts, or nearly 10% of its 2,230 megawatts capacity. The deputy director of Ayami 1 Dam says that they started feeling the pressure a year ago when the river water level had dropped. According to him, reduced rainfall this year and problems with the gas-powered stations compounded the problem.
In Ayame, we got to level 88, when in fact the filling capacity here goes right up to 90.5. So there was already a gap of 2 meters. And to compensate for the losses, at the thermal level, let's say we pulled on the lake water a lot last year. So we took a lot of water from the lake, and unfortunately, this year, we did not get the input that we had accounted for. So all these factors combined have led us to the situation we have today.
At a news conference, the Minister of Energy, Thomas Kamara, says national electricity had been severely impacted since November 2020 and that they had to therefore reduce their export to prioritize need in Ivory Coast.
We have considerably reduced the quantity of electricity that we export to our regional neighbors, given that the national production is not enough, so we have had to considerably reduce how much electricity we export. Our forecasts show that we should return to normal within 2 months.
In Ghana, which exports to Burkina Faso, the national utility is carrying out rolling outages until today, May the 17th. The power regulator blames the problem on several issues, including work on transmission lines and a lack of rain that has left reservoirs depleted in the northern part of the country.
In the meantime, South Africa's struggling power utility Eskom Holdings says it will cut power to customers after losing capacity at some of its electricity generating units. The state-owned company said it will cut 2,000 megawatts from the grid starting from Sunday to Tuesday after losing 10 generating units at some of its key power stations. Eskom explained that this is due to steam leaks at its Matela plant, while generation has also been affected at Medupi, Kusile, and Dovo plants. The debt-laden firm supplies about 95% of South Africa's electricity needs, but it's been struggling to meet demand. Its 464 billion rand of debt has added to the government's challenges in attracting new investment to reignite economic growth in Africa's most industrialized economy. And that's a wrap on the program. Thank you for watching. I'm Chimeze Obi Iwago.